Buried in a remote corner of the internet is a little-known investment forum called bogleheads.org. These guys were fanatical about regular old index fund investing. That is until a new member joined. A member whose ideas would shake the core of the community and change it forever. This member goes by the name Hedgefundie. Some thought he was an investment banker or in tech. Others thought he was just an investment whack job living in his mom's basement. No matter who he is, his ideas really stood out. With regular old index fund investing, instead of buying individual stocks, you buy something like the S&P 500 index fund. This fund gives you a small slice of the top 500 stocks all in one ticker. John Bogle, who created Vanguard, actually pioneered this idea, hence the cult of the Bogleheads. The index fund idea is that by buying the entire market, you essentially buy the haystack instead of searching for the needle, and then you simply hold that haystack forever. And it turns out over the long run, this actually is a better strategy than picking individual stocks for just about everyone. But what if those returns could be amplified? What if you could take the index that beats even the best hedge fund managers and make it even better? That's exactly what Hedgefundie aimed to find out. See, there's two ways to increase your gains in the stock market. First is less diversification, picking fewer assets in attempt to find that needle in the haystack. Or second, you can apply leverage, amplifying your returns. Now, most investors will choose concentration over leverage because it feels more familiar and less risky, but not Hedgefundie. Hedgefundie was loyal to the John Bogle style of indexing, but he believed he could increase returns and minimize downside risk all at the same time. His idea was groundbreaking for the Bogleheads within his community. Now let's say you had $1,000 to invest. First, you'd buy $550 of the 3 times leveraged S&P 500 index. This fund gives you a 300% daily return of the S&P 500. If the index goes up 1%, you make 3%. But this also means if it goes down 1%, you lose 3%. But that in itself doesn't offer a ton of safety. So next you would buy $450 of the TMF 3X 20-year Treasury bond ETF. Then every quarter you rebalance the portfolio to remain a consistent 55-45 split. And the results of this strategy are absolutely fascinating. When the stock market is doing well, you make at least 3 times more money than if you just held an index outright, blowing the average Bogleheads return completely out of the water. But leveraged ETFs are nothing new. A group of Bogleheads fought against Hedgefundie's post, demanding more data and bringing up issues like volatility drag, where in a bad day, the market could wipe out months of gains. But this is where the 45% bond portion of the portfolio comes in. Whenever the stock market goes down, your leveraged index fund loses 3 times more than the market does, which is bad. But this isn't the end of the world because stocks are inversely correlated with bonds, meaning at the same time you're down on your stock position, you're up on your bond position. The profit in bonds would then be rebalanced to buy more ETF shares. The Bogleheads slowly began to embrace Hedgefundie's ideas as he made post after post uncovering research and defending his strategy. He was winning members over one by one. But the little by little approach wasn't enough. His ideas made sense, but not everyone was totally behind him. Hedgefundie needed data that would prove once and for all that his strategy was better than a regular leverage ETF and better than holding an index fund outright. And this is what led Hedgefundie to build a backtest. The idea was to test his strategy versus the market all the way back to 1955. If his method was proven to be superior, he would finally have the full respect of the community and his ideas would be set in stone. So he built the model, plugged in the data, and allowed the simulation to run until finally it spit out conclusive data. His strategy beat the S&P 500 by a lot. The simulation showed that investing $10,000 in the regular S&P 500 netted $5 million by 2019. In the same time period, Hedgefundie's method returned $7.4 million, a 48% higher return holding near identical assets. The Bogleheads had no option but to celebrate Hedgefundie, who essentially grabbed their hands and led them to gold, an investment strategy that could beat the total market with nearly zero effort. Now, this led some of the Bogleheads excited about the data to question, why not just invest in the 3X index and just forget about the bonds? The bonds, after all, make up a small majority of the total returns. And looking at the data, leverage funds have had an amazing run for the past 10 years. In fact, if you invested just $10,000 in a leveraged NASDAQ for the last 10 years, you'd actually have over $1 million. But it's not always that way. Going back historically, you'd have some major drawbacks because when the markets do crash significantly, your leverage fund can take many, many years to get back on track. He regularly points out that this is a higher risk strategy and offers suggestions to help limit risk. A couple of these methods included increasing your bond allocations as you grow older and dollar cost averaging over time into the strategy. This reduces the risk of buying heavily all at once and the market dipping quickly. But all of this begs the question, if it's such a good strategy, why doesn't everyone do it? And this comes down to a few factors. The first is our impression of leverage. When we think of taking on debt, we see flashes of hedge funds like Archegos getting liquidated or Evergrande missing multi-billion-dollar payments. Businesses and people who took on way too much risk and it ended very, very poorly. But the truth is, leverage in and of itself isn't good or evil. It's simply a force multiplier. You wouldn't say this lever is good because the weights are equal, or this one is bad because one side has a force multiplier. Now, what's strange is despite the leverage horror stories that we see in the news, we actually use leverage all the time. Take purchasing a home. Even in your 20s with $25,000 down, you can easily buy a $250,000 house. The bank still owns your home, but you now have $250,000 in exposure to the market. One of the best investments I have ever personally made was a house that I bought for $365,000 when I was 21. I'd been running my moving and storage business for a few years, and I managed to save up around $30,000 for a down payment. I bought the house, lived in it, and rented the additional rooms out. I still own that house, and not even 5 years later, it's worth $700,000. My equity, amazingly, is around $400,000 on that $30,000 down payment. So the home price about doubled, but because of leverage, my initial investment is now up more than 10x in less than 5 years. What's a bit strange though is you hear that story and you probably don't think I took on a lot of risk, but in any other asset, that level of leverage would be insane. I think the difference is with stocks, you can see the price every day. With a house, you can't. There isn't a guy outside my house saying, hey, just want to let you know your house is worth $10,000 less this month. That just doesn't happen, but it kind of does in stocks. So this begs the question, how does a 3x leverage fund work? Are there additional risks that Hedgefundie might be missing? He uses the UPRO 3x ETF. What's important here is funds like UPRO seek investment results of 300% of the daily performance of the index. This distinction here is really important because it can change the long-run returns due to something called volatility drag. Basically, because returns are compounded daily, you can be left with a long-term return or potential loss of far more than 300%, despite the return daily being just 3x. Again, this is a force multiplier, neither good or bad. Now, another alternative to getting leverage is to buy a stock through something called a LEAPS call option. But with this, you need to pay a price. Leverage isn't free. No one's going to sell you an option if they don't believe that they can make a profit doing so. The money paid for an option is a premium, not all that different from the premium you pay on your insurance. But the problem with options is you're often paying extra because premiums are generally overpriced. See, historically, the options market overprices volatility. The VIX index is commonly referred to as the fear index for Wall Street. And when the VIX is high, it's because people are afraid. When the VIX is high, options premiums are often overpriced. But why is that? Well, looking at historical studies, you can see that implied or forecasted volatility often overstates actual historic volatility. There's a simple reason for this. Fear is overstated. Yes, black swan events do exist, but by and large, fear is overpriced in markets. And who benefits from this overstated volatility? The ones selling the options. Fear is overpriced because pessimism sells. People have a tendency to get drawn in by pessimism.
We're down by between 3 and 4.5%.
Is the Chinese economy and the reasons why it's collapsed.
That there'll be a financial crisis.
And that means the crypto and the stock market is crashing.
The S&P 500 index fell to 2,300 points.
In the book Thinking Fast and Slow, Daniel Kahneman says that people are more drawn towards fear and panic than they are rationality. Weighted against each other, losses loom far larger than gains in people's mind. The pain of losing $100 is more intense than the joy of making $100. And nowhere is this fear more evident than the inherent fear investors seem to have about taking on leverage. And this isn't me saying that a leverage ETF is a risk-free way to triple your return. No. Far from it. This is not for everyone. Like we mentioned earlier, if the market dips severely, it can take many years for a leveraged ETF just to get back on track. On top of this, there's a non-zero chance of losing it all, your entire investment. Let's say you're invested in a 3x leverage S&P 500 ETF. If the S&P somehow dropped 34% in a single day, you would lose 100% of your investment. Now, a drop this size has never happened. It's far larger than the largest drop in history, but it's still important to understand that this is possible. And even more, this highlights the importance that Hedgefundie places on having 45% of funds in bonds, which helps you actually make money during market downturns. After figuring all of this out, Hedgefundie changed the Bogleheads forum forever, tempting many users to try out this radically new strategy. It went from a conservative index fund forum to members applying massive leverage and experimenting with rebalancing strategies. For some, playing around with allocation is like trying to bake the perfect recipe. You just keep tweaking the formula bit by bit in search of the perfect balance, when in reality, it's impossible to find the perfect balance because we don't know what the future holds. And we do need to remember the survivorship bias, because as well as Hedgefundie's strategy works in backtests, we can't be certain it will perform the same in the future. And this leads us to the question of, where is Hedgefundie now? He's been using this strategy for years, and I was determined to find out how things have been going for him. But it appears I'm not the only one looking for him. After more than 4,000 posts, he has disappeared from the Bogleheads forum completely. I tried to reach out to him for an interview, but I was unable to make contact. And in a way, it feels a bit poetic that he came into a community aiming to make everyone a little bit richer, completely altered their way of thinking, and left without a trace. Some members are glad to see him go, but most wish that he would come back. I would like to thank the sponsor of this video, KuCoin. I personally use KuCoin to buy and sell cryptos with low fees, but most importantly, I use them to trade with crypto bots and through lending. Through lending alone, I've made more than $24,000 this year on KuCoin. If you use the link in the description, you'll save on trading fees when you get started. From here, I would recommend you check out this video on the wild world of flash trading. And I would just like to thank you so much for watching, and I hope you have a profitable day.